All right. Yes, we are recording this. And thanks everybody for coming in to today's webinar. My name is Kate Hansen. I am with the Center for Rural Affairs and calling in today from Central Iowa. And I'm really glad to be joined by Megan Vaith. Megan, would you like to introduce yourself?
Yes, absolutely. I am Megan Vaith, and I am an agent and owner of Northbourne Organic Crop Insurance, which is based in Scotland, South Dakota, but kind of has a nationwide presence. So kind of all over the place a little bit too.
All right, and we are really looking forward today to talking about crop insurance for diversified operations. This really came about, both Megan and I know that if you have a diversified or a specialty or really any type of operation that's a little bit different than your neighbors, sometimes it can be a little harder to find out what your crop insurance options are. And so the goal today is just to give you an overview of sort of what is out there, what are the kind of high level programs that you might be looking into or available to you, but really just to give you a starting point to actually sit down with an agent and talk about your specific operation. So we're going to do our best to give you that overview today. Our plan after the introductions is going to start off with multi-parel crop insurance, which is sort of an off-the-shelf type policy that may be available to your operation. And if not, we'll go through a couple of other options, maybe Plan B, Plan C, written agreements, whole farm revenue protection. We'll talk about relay and double cropping, pasture, rangeland, forage, which are sort of more specific types of coverage. And then we will briefly highlight some small grains resources made available by the center. And we'll leave time for Q&A at the end. So if you do have questions, put them in the Q&A box. We probably will wait until the very end to get to them, but if you have them throughout, don't be afraid to put them in the Q&A box when you think of them.
Yes, and Kate, I am seeing a comment in the Q&A that someone is commenting that they cannot hear anything. So is anybody else having this issue, or is that just Nancy, is kind of my question at this point.
Thanks for flagging that, Megan. Is anyone else having that problem? I guess if you are, you may not be able to hear us asking that. Okay. Nancy, my colleague Teresa is on under Center for Rural Affairs, so I wonder maybe if she could help you troubleshoot. Okay.
Happy to hear other people can hear us though.
All right. Teresa, if you wouldn't mind trying to help Nancy troubleshoot that. So we are going to start off with a Zoom poll just to gauge where everybody's at, who we have on the call. We'd really appreciate if you would take this call or this poll. We also will have an exit poll, and this helps us to kind of continue our work and see how we're doing. So Teresa, if you wouldn't mind launching the first poll here. All right, so the first question is sort of, who are you? Are you a farmer, rancher, aspiring, nonprofit, government, agribusiness, or other? Second question is just sort of how you would rate your knowledge before the presentation on crop insurance for diversified operations. And the third question we know isn't perfect. There's so many different types of operations, but if you fall into a certain category, we just would like to know kind of who's here and where the interest is. So we've got quite a few farmers, 2 ranchers, some nonprofit and government folks, some interest in small grains, livestock. Really all of them are having quite a few responses. So this is really great, I think, for what we have planned. All right, I am going to end the poll. Thank you everyone for taking that. So before we jump in, a little bit of background about the Center for Rural Affairs. We are a nearly 50-year-old nonpartisan nonprofit, and our goal is to establish strong rural communities, vibrant rural communities, and a lot of that work is with farmers and ranchers role I play on our team here is our crop insurance education work, and it's important to us that operations of all shapes and sizes have the information they need to make the best decisions for them, for their risk management. Most of our staff are in Nebraska. This map will show you kind of where they're located, but we do have actually 6 staff in Iowa, which is where I am calling in from, 1 staff member in Minnesota, and 1 staff member in South Dakota. So these are sort of our states of focus, but of course we are happy to help anyone and everyone.
And like Kate said, I am Megan Vaith, and I work for Northbourne Organic Crop Insurance. And this came about a few years ago, where I took a look at the crop insurance industry as I was just a regular conventional crop insurance agent, and kind of noticed that the organic or specialty farmer was not very well represented. It seemed like they didn't have anybody to go to specifically that understood their operation or was willing to advocate for enhancements for that space. So because of that, I ended up creating this business that's specifically tailored to the organic farmer to help with those issues. And then along with that, it kind of turned into a lot of specialty farmers as well, and kind of opened the door there. So that's been really fun to kind of learn more about that and meet people across the US and be able to help them in that space.
Yes, and I'll just add, Megan has a lot of really relevant experience, and I'm glad she's able to join today and has that agent perspective, especially for the Q&A. It's really, really awesome. I think just a good place to start maybe is, what is crop insurance, if anybody's at that question. Most of today's presentation, we're going to be talking about federal crop insurance, which are programs and policies and products that are administered and subsidized by the USDA Risk Management Agency. They're sold by private crop insurance companies and individual agents, but again, it's sort of administered by USDA. And sort of the conventional way to say what it protects against is acts of God. It's going to protect you against natural perils. We're talking derechos, storms, severe weather events, things like that. And you purchase it to manage your risk. And sometimes it's also required for certain loans or programs in order to be eligible. And really, at the end of the day, it's an input cost, the only input cost that you're guaranteed a revenue out of. You're kind of saying, by purchasing this coverage, I know I at least will come out of the year with this level of revenue. There's also a whole sort of world of private policies, and these are not through USDA. These are privately provided by those crop insurance companies. This is things like hail coverage and some different buy-up type coverage. We're not really going to get into that as much today. We're going to focus on the federal side. And just to give some context and maybe a sense, this graph is showing specialty crop liability between 2007 and 2021. And so as you can see, there has been somewhat of an uptick in terms of the specialty crops that are being covered. This is in part thanks to whole farm revenue protection being introduced, which is part of this yellow section. A pretty significant portion is this blue of fruits, nuts, and trees. So if you're curious kind of what's been the trajectory in recent years of specialty crops covered, we are looking at somewhat of growth. Now, if you walk into a crop insurance agent's office and you say, hey, I have this crop in this county, there's a chance they will say, great, I've got these 4 options for you, or this one is available in our county. And this is kind of how I refer to off-the-shelf policies. These are a number of types of coverage that are already set up per crop by the risk management agency. And if you have these available to you for your crop for your county, it's probably going to be the way you go. And if it's not available to you, then Megan's going to go through a number of options that you might be able to explore. But this is kind of a good place to start. Multi-Parel crop insurance kind of being the umbrella term for all of this. So again, protection against natural perils, that's what you're going to find here. In some cases, you also can be protected from revenue loss due to price changes, due to market changes. So if after harvest, you're finding yourself in a position where you are going to have a revenue loss, some of these policies will cover you. Coverage is available between 50 and 85% by 5% intervals. So 50, 55, 65%. 60, 65%. And that's something you can talk with your agent about what's the best fit for you. The subsidies, or the amount that the government is kind of covering, which impacts how much you're paying, they vary based on that coverage level that you select. So in a very basic sense, if you're down in the 50s and 60s and sort of lower coverage level, you're going to be paying less on your premium. If you're getting up to the 70s, the 80s, 85, you are going to be paying more for that higher coverage. And again, a really critical thing here is that policies are available by crop and by county. So what you're growing and where determines what is available to you. So just to illustrate this, I took a few screen grabs off of RMA's website. These are all for 2022, and the crop will be up here in the upper corner. The counties that have this green color are where wheat coverage is available in 2022. So again, this is where you can walk into your agent's office and sort of get that off-the-shelf coverage. And here wheat has pretty good coverage. There's some exceptions here in Iowa and other counties, but a lot of places you can get wheat coverage. Oats is sort of a similar story, a little bit less as you get further south, but clearly significant coverage for oats. Hemp is sort of a special case dependent on the state. This started out as a pilot program, but here's what you can sign up for in 2022. And then as we get into something like apples, you can see the available policies are a little bit more limited. And then sort of for more of a stark example, tomatoes, really limited in terms of who can sign up for tomato coverage. So again, Megan will talk about if you are in those white counties with those crops, what are your options? But I do want to point out a few more things about multi-parel off-the-shelf type policies. One is a distinction. In some cases, you are ensuring a yield. So you're protecting yourself against production losses. If you're expecting 200 bushels per acre and you only harvest 150, that loss is what you're talking about, a yield loss. In some other cases, in terms of revenue protection, you'll be covered for everything I just said, plus any losses due to revenue reduction, which is due to markets and price changes and things like that. And the next slide I'll show should give you a better example of kind of how this all fits together. Before I do that though, one final number to mention that gets plugged into all of these equations is actual production history. This is your personal yield history that you're plugging in to determine what you should be expecting for your guarantee. So this is an average of between 4 and 10 years of average past yields of your personal yields. And if you don't have that built up already, they will have you use county averages, or T yields is what they're called. Oftentimes, I'm not going to lie, the T yields will be a bit lower than probably what you're growing. But as you continue your career and as you continue building up your yield history, you'll push those averages from the county out, and then you'll only be using your averages, if that makes sense. So you'll build it up to 4 of your own, and then you'll have totally your own APH. So hopefully this kind of helps clarify everything I've been throwing out there for you. The first equation is how coverage is calculated. So RMA will establish a spring starting price for a particular crop. So this is the price for oats, okay? That price will be multiplied by your averages, your APH, average yields, which will be multiplied by that coverage level, that 50 to 85% that you select with your agent. And what that gets you is your guarantee. This is a $1 per acre amount that you're covered for in the event of a loss. So when you say I'm covered for this amount, that's your guarantee. And then if you're in a situation where you need to be talking about a claim or seeing if you're eligible for a claim, you take that guarantee that we just calculated and you subtract the harvested crop in terms of bushels that you actually did harvest, times the fall price. In this case, we're in one of those revenue protection policies, so we are factoring in the fall price. And if there's a difference there, then that's the claim per acre that you're talking about. That's essentially the money you'll get back as part of the protection. And now if anyone's sort of watching and thinking, hey, I'm certified organic, or I'm thinking about organic, what's out there for me? There are a couple of options for organic folks to better ensure the value that you have out there in the field. So one is called organic price elections. This is available for over 80 certified organic crops. It does, again, vary by state and county, but what happens here is you're plugging in an organic price into these equations that we just talked about. So spring starting price for organic oats or fall price for organic. So these are separate higher values that you're plugging in, knowing that your organic is probably going to bring you higher prices. The other option is probably less well known, but in some cases is even better in terms of coverage. And that is the contract price option. So this is available for both certified organic and transitional crops. And essentially, if you have contracts set, you can insure your crop at the contract price value instead of the number set by the risk management agency. So there is an upper limit to that. It's 150% of RMA's spring price. There are exceptions. I think triticale and soybeans, there are a couple of exceptions that are even higher. But generally speaking, you have this cap, but you can insure that higher value up to it. An important thing to know here is if you do want to use the contract price option, you do need to let your agent know when you're signing up for your coverage, but you don't actually have to have those contracts in hand until later. So those are required until at the acreage reporting date, which is later in the year. And so if you just want to keep the door open for yourself, I recommend signing up for it, adding it onto your policy. And then if you get contracts, they do increase your coverage. You probably will be paying a slightly higher premium, but in a lot of cases, it is worth it for that higher coverage that you're getting. So here's an example that Megan was kind enough to put together, kind of showing the difference using the contract price for winter wheat. So this is winter wheat, I believe in Iowa, prices for organic. So the first example would just be plugging in their organic price. They've got $14.54 is what RMA has set for winter wheat. Let's say you've got a 40 bushel guarantee per acre. And so we're talking about a guarantee revenue of $581.60. So this is just with the organic price election, everything sort of going along that route. If you have contracts set up to that 150% cap, that would bring us to $21.81. And so if you can get a contract in that range or nearing that, your coverage is going to increase significantly. And we're talking about a guaranteed revenue of over $800. And so really the bottom line here is if you have contracts set or if you have that higher value out in the field, using this option is a way to actually express that in your crop insurance and better cover what you're expecting your revenue to look like. One other thing before we transition into the sort of other routes of coverage is to know there are what are called endorsements or options or addendums. They're different names, but essentially little tack-ons that you can add to your policy to better cover yourself. So the contract price option, I think, is technically one of them. Another one is the Molting Barley endorsement. I won't read this whole slide, but essentially it's a better way to protect yourself if you're growing malting barley. It's available in select counties and select states, but again, really having those conversations with your crop insurance agent. Hey, my barley is actually malting barley, or I have this niche market identified, can help you identify if there are any special things to add on to better cover yourself. And now I will give it to Megan to talk about written agreements.
Yes, thank you, Kate. So I'm going to go over written agreements and then a couple different options also available to farmers where maybe your standard off-the-shelf policies like Kate was talking about are not available to you. And Kate, I don't know if I'm available to advance the slide. Okay. So written agreements are an option for producers where they can apply for individual coverage on their crop if the coverage is not automatically available to them. So this process often involves a lot of extra paperwork, which might mean maps of your location or production history or letters from what they consider an agricultural expert in the area for reasoning as to why this crop should be allowed to have insurance on it. So basically, in a sense, written agreements are where the producer is asking for insurance on a crop where it's not readily available to them. Some of the most common types of written agreements are high risk, new breaking, and a county without actuarial documents. So high risk written agreements are available to producers that maybe farm on high risk ground. And if you do, you are charged extra premium because they see it as riskier, more likely to trigger a loss. You actually get a lower T yield on it and your premium rate is higher. So they have a written agreement available where you can prove that your planting history has been similar to maybe some other farmers in the area that farm on non-high risk ground, and then they'll allow you to use the same rate as those farmers and not take the extra hit on your premium for having the high risk ground. New breaking is an option that's available to farmers where they can get coverage on land that has not been planted or harvested in one of the last 3 crop years. We see this most often on like native sod acres, or maybe they're breaking up a pasture type of scenario and they're trying to get insurance on the crop that they're planting there. So there is an exemption for alfalfa where it doesn't have to be planted in one of the most 3 crop years because that's part of their normal rotation. This XC written agreement, which is the county without actuarial documents, is the most common one. So what this means is you are requesting coverage for a crop that doesn't have any insurance available. Actuarial documents are just the policies written for crops that can have insurance in that county without extra permissions. So this is you asking for insurance in the county when it's not readily available. Relay and double cropping is the next thing we're going to cover, and that kind of falls under the written agreement category in a sense as well. So for relay cropping, this is a new thing for 2022. So farmers were able to submit written agreements to be able to insure their relay cropped soybeans. And so this means that they planted maybe a first crop or a cover crop, and then they interseeded the soybeans within that crop. And then they're able to harvest the first crop and then wait for the soybeans to grow until harvest time and then harvest them. So you're kind of getting 2 benefits off of the crop. In the past, with the interseeding rules, these were not available to have insurance on them. So this was a really positive change for last year where now there is starting to be some insurance available for them. In order to get insurance on these crops, you have to submit your written agreement to your agent. The agent has to submit it to the insurance company by sales closing, which is March 15th for most crops. So that's why I use this here. And then there's also a map that kind of shows what the restrictions are per area over the entire US. So some areas of the US require prior relay cropping history to prove that it's a practice that can work in your area before they allow coverage. And a lot of times that's 3 different years. But there are some areas as well that just allow you to have the coverage without needing prior history. So something to kind of keep in mind and on if this fits your operation. Double cropping has been around for a while in some areas, but they actually just made an announcement, probably a couple weeks ago here, where they are expanding the insurance coverage program for 2023 for both soybeans and grain sorghum. So double cropping allows farmers to raise 2 different crops in 1 year. So you plant the crop and then you harvest it and then you plant another crop and then harvest that one. So you get 2 full crops in the year without overlap between the 2 of them. That's the difference. So this first map here is going to show what double cropping coverage is available for soybeans. So as you can see, there's different colors on this map and they kind of all mean different things. So the yellow portion there shows that you have to submit a written agreement in order to get double cropping insurance available on your soybeans. And with that written agreement, you need 3 years of prior history proving that you have grown this crop and grown crops through double cropping in the past. That green area allows you to submit a written agreement without any history. So you could be doing it for the very first year in 2023 and still receive coverage on it. And then that blue area is where coverage is automatically available without submitting a written agreement. So you don't have to submit any extra paperwork or anything like that. And that's also kind of the area where it was insurable in the past. Then this next map shows what double cropping looks like for grain sorghum. So it doesn't cover near as large of an area as soybeans did, but probably not as popular of a crop either. So here the coloring means the same as it did on the soybeans. For the yellow, you have to have prior history to submit the written agreement. The green, you can submit a written agreement without history. And then the blue, you automatically have coverage without any extra paperwork. The next policy we're going to cover is whole farm revenue protection, which honestly, we could do an entire presentation in itself on whole farm revenue protection because it can be pretty complicated. So we just wanted to kind of go through the main overview of all of it for you guys here. And then if we have questions, we can absolutely get into that, but we didn't want to spend an entire hour talking about this one policy specifically. So whole farm revenue protection is actually a really great option for your diverse or specialty farmer where maybe you don't have your off-the-shelf multi-parel policies available to you and maybe written agreements aren't an option. So this policy covers the overall revenue for your entire operation. So it's different from the policies Kate was talking about because yield doesn't really come into play. It's all based on revenue. And they do that by looking at the previous 5 years of Schedule F history to look at your average allowable revenue on those Schedule F forms, and then they compare it with what they think your expected revenue is going to be for the next crop year. So in this situation, it'd be for 2023. So in order to qualify for this, unfortunately, you have to have 5 years of consecutive tax history so they can look at the average allowable revenue. However, beginning farmers do get an exception and they only have to have the 3 years of history. One of the benefits to this policy is that if you have 2 or more commodities, which is 2 or more crops, or maybe it might be a crop in livestock, you actually get to receive a whole farm premium subsidy. So that helps cheapen up the premium a little bit. Coverage of it levels are available from 50% to 75% for the producers that have 2 or less commodities. And then if you farm 3 or more, you're actually able to have 80 and 85% as well. So if you have 3 or more commodities, you can assure all the way from 50% to 85%. So it gives every producer quite a few options for maybe the different guarantee you need to be at or price points if you're looking at premium. A huge benefit to this policy is it can virtually cover pretty much any crop available except for the ones that we have listed here. So that's a really big benefit where on your typical multi-parel crop insurance, you won't automatically get coverage for every crop. So like I said, since this follows the Schedule F tax year revenue, unfortunately, claims will not be completed until after your taxes are filed for that crop year because they have to look and see how your revenue came in for the year. So where on like maybe your typical corn and soybeans, you're used to having a claim in the fall and getting paid out right away. Unfortunately, with this, you won't get paid out until after taxes are filed. So typically it falls into the summertime of the following year. Another downside to this policy, which I don't mean to shy anybody away from it for this reason, but it does require a lot of paperwork. So here we have a list of all the different forms that are required to submit with the whole farm revenue protection application. Depending on your operation, some of them might not apply to you depending on what your crops are. So it is quite a bit of paperwork, but it could be worth it in the end. So I get this question all the time on whole farm revenue protection. When we first start talking about it, all the producers want to know, is it worth all the paperwork? Which is a great question. And unfortunately, like most things in crop insurance, it depends. So this depends on your operation. So if you can't purchase multi-parel crop insurance, which is MPCI here, if you're reading along on the slides, then this is pretty much your only option for crops. So in that sense, it's a great option because it's kind of this or nothing. This is also a really great option to have as an overall safety net on your entire operation to make sure that your revenue is fully covered for the year. So you can actually use this as an umbrella policy in a sense over your standard multi-parel insurance. So if you farm corn and soybeans, and then you just want this to protect everything on top, you can absolutely do that. And there's even a benefit to doing that. They actually give you an extra premium discount on your whole farm revenue protection, since you have other insurance as well protecting you. So I often get the question a lot is, what is covered under allowable revenue? Like, why is it called allowable revenue? Why isn't it just revenue straight off of your Schedule F form? This is because in order to calculate what is allowed to be covered for your policy to figure out your guarantee, they have to take out some programs that maybe won't be consistent. So like the agricultural program payments are not included in there, and custom hire is excluded as well because they don't specifically pertain to the crop. So everything has to specifically pertain to the crop. Unfortunately, post-production expenses and revenue are also excluded as well. So applesauce and jams are often the most ones included in here because it's the apples being covered, not the applesauce. So that's after production that they change the apples to applesauce, so it is not covered. So there's a couple different ways to set up your policy, and a lot of these are new. So I get the question is, how do I set up my policy? Do I do it line by line commodities, combined direct marketing, or microfarm, which is probably foreign language to a lot of people listening here. So just bear with me as I kind of try to explain it a little bit. So line by line commodities is kind of how the first policy came out. And this allows you to insure each commodity separately. And in order to do this, you have to know your expenses, revenues, and yields for each commodity in order to calculate what your guarantee is and your expected revenue for the coming year, and then along with your actual revenue at the end of the year. Combined direct marketing is a new product, or a new structure, I guess, that came out a couple years ago. And this allows you to combine all commodities together under one line rather than keeping track of them individually for each crop or commodity code. So you don't have to have the expected values and yields for each crop. Instead, you can just say, here's my expected values and here's the yields for all of my production. So this can be useful for farmers that sell their commodities directly to the end consumer, most often through like a farmer's market or a CSA type of operation. In order to fall under this category, you have to report at least 2 different commodities that are sold through direct marketing. So this structure is only available to farmers for the crops that they sell directly to the producer, not to anybody else. This combined direct marketing commodity code automatically equals 2 different commodities, even if you have 10 commodities under there, which is kind of important because the more commodities you have listed, the more of a discount they give you on the premium, because they kind of give you a bump for being diverse. So the combined direct marketing always equals 2 commodities. Microfarm is a new structure that just came out last year, so this is brand new still for now. And this allows producers to insure all their agricultural commodities on the entire operation together. So you can combine everything together, whether it's any type of crop, whether it's direct marketed to the customer or sold to an elevator or whatever it may be. The commodity code for this one always equals 3. So the farmer is automatically eligible for the 80 and 85% coverage levels. Like I said, since everything is combined together, you do not have to have separate expected yields and values for each individual crop, which is really nice. But in order to insure under this structure, you have to provide your consolidated sales records for the most previous 3 years so they can see what your revenue was over the last 3 years and establish a guarantee for the coming year. The huge benefit to this policy and why I really like it so much is that revenue from your post-production operations can be added to this. So applesauce, jams, all of that can actually be included here, where in the past it wasn't included at all. So that's really nice.
And I want to add, Megan, they define microfarm here as $100,000 or less of that approved revenue, if I'm correct. So that is how they're defining microfarm. Currently, that's who's eligible.
So here are some of the benefits for each commodity type. So the line by line commodities is nice because you can have an unlimited amount of commodities, which in turn means more premium discounts by the more commodities you have. Combined direct marketing is really nice because it combines all the sales records together for any crop or commodity that was directly marketed to the consumer. So this makes it a lot easier for reporting rather than the line by line commodities. And then Microfarm, like Kate mentioned, is really great for the smaller producer where they can combine everything together. And as she said, it's only applicable to farmers at this point that have less than $100,000 of allowable revenue. I know they added a restriction in there where like if you purchased it in 2022, then next year you can have $125,000 of allowable revenue. But for farmers just starting out, it is at this moment 100,000, but hopefully we see that number shift up in the future. But as of now, it is still at that 100,000. The other, I already touched on this, but the other main benefit to Microfarm is that you can actually finally include your post-production revenue and expenses, such as that applesauce, jam, apple butter, whatever it may be. Pasture, Rangeland, Forage is another policy that it's actually my favorite policy. It is available to farmers that farm any perennial haying or grazing ground. And so I often get the question of like, you know, I can have insurance on my corn, soybeans, oats, maybe tomatoes, whatever it may be, but why not on my alfalfa or my pastures? Well, here's an option for you. And this has been around for a long time, but it hasn't been widely talked about. And so why I like this policy so much is it actually offers more flexibility than any other crop within the crop insurance program. So farmers are actually able to pick and choose which fields they want to insure. And so, for example, if a producer has a corn on their crop insurance contract, any acre they plant to corn in that county automatically has to be insured. Where this policy, you can choose just to insure one field and not everything that's either haying or grazing on your operation, which is really nice. Another thing is your haying land can actually be insured at a different coverage level than your grazing land, which offers flexibility to choose what coverage level makes sense for you at the guaranteed revenue and the price point that you're looking at for premium. Another main thing I like about this policy is it is stress-free. So typically you have multiple reporting times throughout the year where you have to do sales closing, where you figure out your coverage level and your guarantees, and then you have to do acreage reporting where you report your acres. And then after that, you have production reporting, which you report your yields. This is really nice because you do not have to report any rainfall data or haying yields. And so this policy strictly covers you on a lack of moisture on your haying and grazing land. And so if at the end of the year, they, or at the end of the time period that you select, I guess, they see that you were lacking in moisture in that time period, the crop insurance company will automatically cut you a check. And so you don't have to call and say, I don't think I'm, meeting my moisture requirements for the crop insurance policy. They just automatically look at the numbers that are established through the NOAA and pay based on that. Okay, I think we might have missed a slide if you want to go back like to, oh, never mind, I must have cut it out. Never mind. Here's an example of kind of how this policy works. So in order to insure under PRF or Pasture, Rangeland, Forage, you actually have to select two different 2-month intervals at a minimum throughout the year. And so here's an example of my farmland here in Southeast South Dakota. And so the top is kind of like my coding on how I do this. So what I have punched in here is 40% of my acres in February, March, 10% in June, July, 10% in September, October, and 40% in November, December. That's what all those numbers and letters mean, but I don't expect anybody to remember that because this is just my quoting. And so here we have a 10-year run out of how this policy is paid. So when I look at this policy, I like to look at the most previous 10 years weather patterns to see where we might be lacking in moisture over the last 10 years. So as you can see, this is 2020 through 2011. And I see on that middle column, it says premium for 100 acres. This is actually 1 acre. So I must have not got that changed. So I apologize for that. But the first column shows the indemnity that was paid per acre. So anytime that there was less than 90% coverage, an indemnity was triggered. And so this is the indemnity that was paid. And then the premium for this coming crop year was $8 per acre. And then so the last column shows the profit for each year over the last 10 years. So as you can see, the last few years were kind of rough. I didn't collect anything. However, over the long term, you can see that over the last 10 years, I ended up coming in a profit over this policy. And any single time I run these scenarios, the farmer always ends up in a profit over the long run. So I think this is a really cool policy where you can just kind of make sure that you have extra coverage in case you don't have the moisture, so you don't have like anywhere to put your cattle out on pasture or the haying land that you're used to having.
All right, I feel like we're kind of doing a marathon here. We've been talking about a lot of different options. And again, our goal is really just to give you a flavor of what's out there so you can talk to an agent about your specific needs. We just have one more thing and then we're going to get to the Q&A. I did want to share the Center for Rural Affairs has just released some new resources specifically about small grains, so that might not apply to everybody on the call, kind of given what people responded to the poll. But for those that are interested, these are some fact sheets, kind of front and back type things on specifically wheat, rye, barley, and oat coverage. And so we went in and really specified what is available for each small grain, if that's a part of your operation. You'll see on here, we've kind of selected the states that we work the most closely with as the Center for Rural Affairs, but all of the other information is pretty much nationwide, talking about all states where it's available. So don't let the map discourage you. If you're not in one of those states, the information will still be relevant. I think my colleague is going to put the link to these resources in the chat if you want to check them out. And otherwise, I believe we put it in your reminder email this morning, and we'll get that link in the follow-up email as well. So definitely check these out if you're interested in small grains coverage. So with that, we will pause and give time for question and answer. I think Megan and I's biggest goal was just to make enough time for this if people had questions. And again, I'm really excited she's here. I am happy to help, but Megan is really on the ground selling this every day. So we can tackle whatever you've got, or we can follow up if we don't know. I do see a question already from Elston, who says, is crop insurance generally unavailable to small farmers? The small farms I'm familiar with do not utilize it. Why is this? Megan, do you want to take a stab at that, or do you want me to try?
I can. Okay. I can. And I'd maybe like a little bit more clarity on what you consider like a small farm, because I think it depends. Which I said kind of everything in crop insurance just depends on the scenario. So if it's a small farm that's growing like your typical crops, there's definitely insurance options available to them. But if it's a small farm growing tomatoes, cucumbers, apples, something like that, then that makes it a little bit more complicated. What I see is a lot of times smaller farmers are more diverse than your typical, corn and soybean farmer. They grow a lot of different crops, which kind of spreads out their risk throughout the different crops. And so they don't see crop insurance as a good option for them. I'm not saying that they don't have any options, but that's my observation with all of it. And so yes, it is still available to them for the most part, depending on their crops and how their history is too, because a lot of the like written agreements and whole farm revenue protection require prior history. But I do see a lot of farmers in the organic and specialty space not utilizing crop insurance more than your typical non-organic or non-specialty farmer. And if that did not answer your question, feel free to type more or whatever. We're happy to expand.
Yes. If anybody else has questions, please put them in the Q&A. And I think while we're waiting, Megan, do you want to just give us kind of a flavor of what we didn't talk about today? This is obviously just a sample. What other types of programs are out there for federal crop?
One of the first things that comes to mind, I guess, is livestock insurance, and really only because you had mentioned that some people posted in the poll that they have livestock. And so livestock insurance has been around for a long time, but really hasn't been widely used until 2021. And that is because they increased the subsidy levels on it. So it is becoming fairly popular, but not a lot of people are really talking about it yet. And that policy is really cool because it allows you up to almost virtually 100% coverage on your livestock. So what they do is you can pick different time periods throughout the year, meaning 13 weeks all the way up to 52 weeks, depending on your livestock. And by livestock, it mainly caters towards cattle and swine. So they look at a time period where you think you might be selling it at that point. So maybe we'll just say 13 weeks. And so they have reports through the risk management agency for what they are predicting the expected ending value to be as of the end of the 13-week time frame. And then you can have insurance almost up to 100% of that value. And then at the end of the 13 weeks, if it falls below that ended expected value, where the prices for the area, they track area prices to calculate it, then the producers automatically cut a check. And so I see a lot of farmers shifting to this insurance mindset because it is subsidized rather than working with a broker. So it is becoming more and more popular and just something to be aware of. If you have livestock, it might be worth a conversation with your agent about.
All right, we have a question from Jackie. Hi, Jackie. Are most crops allowed for relay cropping insurance? I assume soybeans was used for the example and others are insurable. And actually, I don't think that's the case, unfortunately.
I think soybeans are, for the most part, it, from my research and experience, unfortunately.
Yeah, my understanding, Jackie, is the same. It's beans and a cereal grain at this time. And I would imagine that there may be potential for expanding that. RMA is really just diving into this with it being new last year. But currently, I believe it is just soybeans. All right, we have another question from Tony. Is there any insurance option for contract poultry growers?
Unfortunately, whole farm revenue protection is kind of your only option at this point. Going forward, hopefully there will be more. Like Kate said, we're really working to advocate for more insurance options for both specialty and organic farmers because we see that it's lacking quite a bit in the area. So we're really trying to advocate for more. I don't know if this is on the docket for sure or not, but I know whole farm revenue protection is an option at this point, and that's pretty much it. On the livestock protection side of it, they used to offer it on, I think, sheep as well, and they went away with that. So that also would only fit under whole farm revenue protection at this point.
We've got another question here from Lauren. If crop insurance covers revenue and price loss outside of natural weather events, including change in price due to markets, what is the difference in or advantage of using crop insurance compared to commodity support programs like PLC or ARC? So the FSA commodity programs.
Which is a great question. That's a very, very great question. The main reason to use it is because PLC and ARC are going to be tailored towards the county revenue and losses, where crop insurance will tailor towards your specific operation with your guarantees. You can also have much better coverage by choosing different coverage levels. I think that they need to be used side by side in my opinion, because crop insurance will cover you much better and make sure that you are established at a certain guarantee level, where PLC and ARC will only cover you depending on the county and nationwide prices. And then it goes into Olympic averages as well for like ARC coverage, where like the most previous 5 years pricing history and yield, and like crop insurance will only look at current pricing, so it will not be maxed out from that.
Thanks for that question and that answer, Megan. Marilyn wants to know, what do you suggest for organic when finished with 2 transition years and entering certification year? This is for field crops. So sounds like on their second or entering their third year.
Yeah, so almost ready for an inspector to come out. Exciting time. First of all, that's very exciting. Second of all, we actually didn't even touch on this. We probably should have. They made a new rule for organic farmers for their third year of production when they're just starting to enter certified organic production, that when you're going through transition, you're supposed to insure your crops under transitional organic, which provides a organic tea yield for you, but the conventional price as well on the crop insurance side. So your coverage isn't very good for your transition years. So they made an exception for that third year, that as long as you can prove that you're following an organic plan and have applied for certification, you can actually insure your crops on that third year for certified organic. A little late for this year, but we didn't cover that. And I think that is a really good information to have for producers. So back to the question, I would suggest, if you're just doing field crops, I would suggest doing, like, looking to see if you have revenue protection in your area. That would probably be the best bet. And then using that contract pricing option that Kate talked about. And so I think, in my opinion, contract pricing is the biggest benefit organic farmers have in crop insurance. Non-organic farmers don't really get to personalize their crop insurance policy as much as organic farmers do in that instance, because you can actually personalize it towards what your specific contracted price is. And so in order to do that, Pete already mentioned this, but just to reiterate it, you have to have a certain option on your policy by sales closing, which is in most instances around March 15th. And then you have to submit your contract to your agent by July 15th. So that you can use that on your crop insurance policy in case you get a loss, which, as you saw, can make a huge difference in what your guaranteed revenue is for the year. So I think that's a huge benefit to organic farmers. That's what I would suggest for a starting point. Go ahead, Kate.
Yeah, and I just want to clarify, let's say you have 1,000, maybe that's too big, 500 acres of a particular crop, and only 100 of them are under contract. So that contract price option is just for those 100 acres. Is that correct?
Yeah, a lot of times they use like an average. So they average out the price over the 500 acres rather than saying just these 100 acres are this price. But yes, that is correct. You cannot use that contract on every single acre. Sometimes they allow it if it's close, like maybe 450 acres are under contract. Sometimes they let the other 50 acres have that contract price, but it's kind of case by case. It's important in that instance, it's important to work with a agent that has good relationships with the crop insurance companies they're working with, so that they can have things like that happen, because there's a lot of communication back and forth when it comes to contract pricing to make sure it gets implemented properly.
Yeah, and I would echo that. You know, these are federal programs. In theory, you can go into any crop insurance agent who sells federal crop insurance into their office and sign up for any of them, buy any of them. The difference sometimes you find among agents is how much time they're willing to spend with you, or if they have worked with an operation like yours before. And I would just emphasize it is good to have a good fit with your agent and make sure you're working with somebody that you gel with and is really interested in working with your specific operation. That does not mean it has to be the person down the road. Really, the only requirement is that agent is licensed in your state to sell crop insurance. So if they're in a neighboring state, but you can get stuff done via phone or via email or whatever, I would consider it. I would ask around, ask fellow farmers who they're using, because sometimes that fit really does make a significant difference in your coverage and kind of your experience too. Do we have any other questions? I appreciate everybody who's had them so far. These have been really good questions. We do have a couple minutes.
Yeah, nobody's been too hard on us yet, so waiting for it to come in.
Right, knock on wood. All right, I'm gonna give it like a couple more seconds. And if we don't have any more, I'm going to jump into the exit poll. And again, would really appreciate it if everyone would take the exit poll. It's just one question, how you feel like your knowledge is at this point. If you felt it grew, that's great. So thank you in advance for filling this out.
And while we're doing that, Kate, I just wanted to thank you for having me on. It's always good to share some information with growers. I just feel like there's a lack of information out there for specialty and organic farmers. So it's really great what the center does and does things like this to help spread the information.
Yeah, and thank you, Megan, for joining us. We really appreciate your expertise. And I think both of us are really accessible via email or phone if anybody has follow-up questions. I think I'm sharing my screen now, if everybody can see that with our contact info. My email and phone number is also in that follow-up email that you'll get. So you can get to Megan through me as well if you want me to email you her info. Again, be in touch. We recognize that there are probably a lot of different types of diversified operations on the call today, and we appreciate you spending the hour with us and hope it was informative.